All right, for all the impatient people out there who are itching to get started, this video is for you. Yeah, I'm looking at you. We want things now, not in 1 to 2 to 3 or 5 years, or even anything like that. Before I cover strategies for faster results with real estate and give you some ideas about how you can accelerate the timeline of financial freedom, let me put all this in perspective. Okay, you're investing in multifamily real estate, so you're already on a 1 to 3 year retirement plan, right? Is that time frame too long compared to the 40-year plus retirement plan of most people? Is that too long when the end result is that you can quit your job and do whatever you want? Now, most people might say no, and they acknowledge that as far as retirement plans go, this is probably the fastest they've ever heard of. Nevertheless, 12 months seems like a long time to many people to do their first deal and start their journey to financial freedom. So I'm going to go over 4 different strategies to get your first deal done faster and achieve financial freedom. So watch through all 4 and figure out which one works best for you, and then let me know in the comments below. This is your shortcut to retirement and financial freedom. It took me a long time to do my first multifamily deal. From the time I flipped my first house to doing my first apartment deal, 6 years had gone by, okay? I was distracted by shiny objects. I flipped houses, got into restaurants, traded options for a while. It took me a long time to figure things out. I made a lot of mistakes, and I lost a lot of money in the process. Well, hey there, welcome to the ultimate guide to financial freedom and real estate investing. The whole course is here on my channel. I'm Michael Blanc. I'm a full-time entrepreneur, investor, and coach, and I'm passionate about helping others become financially free in 1 to 3 years by investing in real estate. Through my investment company, I control over $300 million of real estate, and I've helped my students acquire over 14,000 units at the time of this recording. So hit that subscribe button and notification bell if you want to be financially free in 1 to 3 years and you don't want to miss any more of these training videos. Let's do this. I certainly didn't think I could do my first deal in 90 days, but many people are doing just that, and I'll show you how they've done it. Sometimes it's a combination of focus and a bit of luck. Take Ed Hermson, for example. He got his first 22-unit deal done in just 3 months after signing up for one of my programs. Taking my advice to heart, Ed recruited a property manager as one of his first team members after interviewing nearly a dozen of them. One of them referred him to an owner who was interested in selling, and that's how he found this off-market deal. When I interviewed him on my podcast in episode 48, just a few weeks after closing that deal, he was already working a 50-unit deal. This is the law of the first deal in action. So Ed did his first deal in 3 months. Will you get the results in 3 months? Well, maybe or maybe not. But even if it takes 12 months or longer, remember that you're on a 1 to 3 year retirement plan. So what if it takes a little longer? Now, I know. I can already hear the impatient crowd mumbling, yes, Michael, that's great. But do you have a shortcut up your sleeve? Well, I've got a few for you to consider if you want to do your first deal in like 90 days. So pay attention and book a call with my team at themichaelblanc.com/call if you're looking for some extra support. So strategy number 1 is to buy a duplex, a smaller deal. If you want to do your first apartment building deal in the next 90 days, then consider starting with a duplex. That's exactly how JB, Drew Niffin, Brooks Everline, and Tyler Sheff got started. That triggered the law of the first deal to financial freedom. Now, why is buying a duplex so much faster? Well, buying a duplex shortcuts the process of getting into multifamily investing for several reasons. Number 1, there's way more of them, and they're easier to find. There's so many more duplexes and quads and larger multifamily properties. You don't need to build relationships with commercial real estate brokers so that you take you seriously. Just go to realtor.com, the MLS, or call your local real estate agent, and you'll have dozens of duplexes to choose from. Number 2, you need less money, obviously. In many parts of the country, you can buy a duplex for the price of a single-family house. So according to realtor.com, the median home price in the United States was around $250,000. If you assume you need $20,000 down, you only need about $40,000 to $50,000 cash to close. A lot more doable than requiring, say, $250,000 to buy a $1 million apartment building. Number 3, duplexes are easier to analyze. Analyzing a duplex is like buying a single family house. Right? You calculate the cash flow, potentially the after repair value. If you're renovating, ensure you make the cash on cash return you're looking for. So with duplexes, you don't have all the expenses you have with multifamily properties. You really only have property taxes, insurance, repairs, and a mortgage. Number 4, you don't need to build a huge team. To get into multifamily business, you'll need to build a trusted team of property managers, attorneys, brokers, lenders. To do your first duplex deal, you don't need to spend weeks building a team. You'll probably self-manage the duplex. Your local real estate agent will help you take care of the closing and refer to a local lender and insurance broker. Super easy. Number 5, cash flow per unit tends to be better than that of a larger multifamily property. It turns out that the house rentals actually make slightly more money per unit than larger multis. So while finding multifamily deals with a cash-on-cash return of 10% or higher might be challenging, it's considerably easier with single-family houses or duplexes. Now, in short, finding a duplex is easier, faster, cheaper, and more profitable per unit than a larger multifamily deal. As a result, it's not unreasonable to buy your first duplex in the first 90 days when a larger multifamily property might take longer. Now, are you wondering how you could buy your first duplex in the next 90 days? Here is your 90-day checklist, my friends. The 90-day checklist to buying your first duplex. All right, so if you want to buy a duplex in, say, 90 days, here's what you're going to do, week by week. Week number 1 is educate yourself. This is the same first week of the pre-launch sequence we already talked about. You're going to complete a course or seminar, and we have some. Just book a call with us at themichaelblank.com/call. We're happy to tell you our resources to help get you educated super fast. And so while investing in duplexes is less complex than larger multifamily, you should still know about finding and analyzing duplexes, raising some money if you have to, and managing the property. Okay, so week 1 is education. Week 2 is you're going to determine your investing area. Decide where you're going to look. Since duplexes are more readily available, there's a good chance you can invest closer to home. For example, it's nearly impossible to find good apartment buildings in Northern Virginia, where I used to live, but I could drive an hour and find dozens of cash-flowing duplexes in smaller, more rural towns. All right, in week 3, you're just going to analyze deals. Shoot for 5. So here are the recommended steps I recommend to use an analyzer to track your duplexes. Go to Realtor.com, get the listings of 5 duplexes. Okay, make sure you get the number of bedrooms, square footage, the rent they're currently getting from the listing broker. If they can supply you with expenses, that's even better, but not required. Now create a spreadsheet to track your deals side by side. So multiple columns. Include the asking price, offer price, number of units, square footage, and rental income. Then for each duplex, create a simple profit and loss summary. Use the rental income supplied by the listing agent or from the realtor. Assume that you have 10% vacancy per year. And for expenses, you can use the Realtor.com figures. They're towards the bottom of the listing. It conveniently calculates taxes, insurance, etc., and mortgage payment. And then I suggest purchasing a home warranty plan, which is typically $400 or $500 per year, that has a $100 deductible. Then budget $100 per month for repairs. The larger items should be taken care of by the home warranty. Okay, once you have 5 duplexes side by side in the spreadsheet, evaluate each deal according to these 3 criteria to determine if the deal is good. Are the current rents at market, or is there a chance to raise them? Find out by going to rentalmeter.com, which will give you the median rent for similar properties in that area. Then what's the current value? What is the value or comparable in these properties? Are you getting a deal or are you overpaying? If you're renovating the property, what is the after repair value? Right? You can get this through your agent by giving you comps of similar properties. It's very common when, for example, when you're flipping houses, and your realtor can supply that for you. Then the question is, what is the cash-on-cash return, right? Compare the cash flow of one duplex to the cash flow of another. You get the rents, the expenses, how much you're putting down, and you get your cash-on-cash return. Question is, does it meet your minimum return? And then focus on the deals with the highest cash-on-cash return. And typically, you're going to find stuff at least 10%. Week number 4, create your sample deal package and start raising money. If you need to have raised money for that, you don't need to raise any if you have the $25,000, $50,000, but you certainly are encouraged to do so, and that would be in week 4. So in this week, you create your sample deal package, which looks and feels like the same document that you give investors when you have a deal under contract, except that you don't have it under contract, right? So to review how to create a sample deal package, go back to the section of the video, how to create your sample deal package. Now I realize that you may not have to raise any money if you're buying a duplex because you have the money yourself. That's great. And that's one reason to buy a duplex. You're not spending time raising money, but I'm incorporating into the 90-day checklist to be more conservative because it's valuable to learn the skill of raising money, whether you have your own cash or not. So to summarize, in the first 4 weeks, you laid the groundwork for what's next. You educated yourself, finalized your investing geography, created your deal analysis and tracking sheet, and crafted your simple deal package. So for the next 60 days, you're going to focus on 2 activities. But first, before we do that, hit that subscribe button and notification bell so you don't miss any more videos about how to achieve financial freedom. All right, activity number 1 is to schedule 1 investor meeting per week. Using the sample deal package you developed, reach out to your sphere of influence and schedule meetings with people who might be interested in investing in your first duplex deal. If you follow this step, you're going to have 8 meetings in the next 60 days, right? You got 8 weeks. and at least one of those will agree to fund your first duplex. If you have your own funds for the first deal, great, but I still want you to start the money-raising process so that you have the funds for the next deal. Activity number 2 is to make 5 offers per week. It's going to be easy to do. There's plenty of duplexes to make offers on, and your agent can help. Continue adding deals to your offer tracking sheet and make offers as you go along. If you make 5 offers per week, not hard to do, that's 40 offers in 60 days, and your goal is to get just 1 accepted, and that's also a reasonable goal. And you can see them side by side. You're going to start recognizing better deals as they come across. That's it. That's your 90-day plan to buying your first duplex well in the first 90 days. If you thought you needed tons of cash or experience or time to get an apartment building investing, then I've got news for you. You don't. If you're struggling with the idea of doing a larger multifamily deal and you're about to give up, then buy a duplex. Or better yet, schedule a call with us and let us help you. It's themichaelblank.com/call. And once you have that deal under your belt, even if it's as small as a duplex, then the law of the first deal kicks in and you're going to start doing bigger deals. Either way, though, you're in the game and on the path of achieving your financial goals with real estate investing just by starting small if that gets you in the game. Strategy number 2, partner to fast track your first deal. The second strategy you can use to really fast track your first deal is by partnering. And this is super, super common because your contribution to the partnership is maybe delivering a pre-negotiated deal on a silver platter or bringing capital, right? There's so many things you can do to bring bring something to a partnership. And then your other partner, for example, can raise the money and or leverage their track record to close the deal and get financing. Of course, this only gives you a slice of the pie. Partnering always does, but you realize it also gets you into your first deal faster. Also, this first deal would give you track record, prepare you to do your next deal on your own, and trigger the law of the first deal sooner. And that's, if you remember Joe Fairless on the podcast, right? He's the host of the popular podcast, Best Ever Real Estate Advice, a good friend of mine. That's how he did his first deal, was partnering. It was a giant 168-unit property in Cincinnati. That was his big deal. And he partnered with an experienced syndicator to leverage that partner's track record to get into the deal and get it under contract and help to raise the money, because his partner helped raise money as well. And after doing that first deal, Joe no longer needed that partner for the second deal. Another example is JB, who I introduced you earlier in the training, and he also partnered with an experienced syndicator on his second deal, his 36-unit deal in Phoenix. Now, he gave up 75% of the first deal, and he still had to raise all the money. Now, this may be an extreme example. I'm like, Jay, did you have to give up that much, equity? And he goes, well, maybe not, but I got into the deal. And that is the exact mindset that I'm trying to get across to you. Is you might have to give some equity, but so what, right? He gave up a lot, but now he's in a deal and he's positioning himself for larger deals that he can do himself in the future. Now, it's interesting to note that many successful apartment building entrepreneurs partnered on their first deal and even subsequent deal. This is an important data point that you should not ignore and strongly consider. So it's not an outlier, it's actually more the norm than the exception. Now, at this point, you might be sold the idea of partnering, but you're unsure about how to find your potential partner. It's actually easier than you think. Okay, here's how you're going to find your potential partner, because finding good deals is always a challenge, even for the experienced syndicator. But for them, the problem isn't maybe raising the money so much, but finding high quality deals. And we're still like that, right? So if you can deliver them a deal on a silver platter, they would be eager to speak with you, right? So I'm telling you this so you don't feel anxious about cold calling an experienced syndicator. The truth is, if you have a deal, they want to hear from you. Now, where do you find experienced syndicator? Here's a partial list to get you going. So number 1 is your local RIA or meetups, right? Online communities like the Bigger Pockets or our Dealmaker Mastermind. You can ask your team members, brokers, property managers, referrals to owners in the area. Now, if you want our help, then book a call with us at themichaelblank.com/call. We have a variety of programs that will guarantee will be right for you and help you get on your journey. So check it out and see if it's right for you. That's themichaelblank.com/call. Now, finding potential partners is relatively easy, but approaching them in the right way is important if you want to get their attention. So here's what you should not do, okay? I get emails like this all the time. Hey, Michael, I have a great deal. See attached. What do you think? Hey, don't do that. I'm exaggerating slightly to make a point, but it's not far off. Many people think that sending a marketing package from a deal listed by a broker gets their foot in the door with an experienced syndicator. I very, very, very strongly dislike getting emails like this from people because it proves to me that they're not educated, they don't respect my time, nor understand how to provide value. So don't be like that. Here are some tips for approaching potential partners in a way that makes it easy for them to engage with you. How to get a deal partner ready. So I'm going to describe to you how to get a deal what I call partner ready to the point where it's ready presenting for a partner. So before approaching a potential partner, you need to get your deal what I call partner ready. That means you should ensure the deal meets the partner's general requirements, have the deal properly analyzed, and have some kind of inside track on the deal. So let's talk about each of these in turn. Number one, know your partner's deal criteria. Every potential partner has a different investment criteria, and it's important to find out what they are, ideally in advance. So ask them these kinds of questions. What range of unit sizes would you consider? What cities or areas would you consider? Do you prefer stabilized or value-add deals? What kind of returns are you looking for? Cash on cash? What terms do you like to see in the contract? What would be the process for bringing you a deal? So tip number two of approaching an experienced investor is to properly analyze a deal. And the only way to know if your deal meets your partner's criteria is to analyze a deal with a good apartment deal analyzer so you can determine the returns. We have one, the syndicated deal analyzer is probably the best thing to use for the investment. Just use it. Correctly completing your financial model, though, is not enough. You could be 100% accurate with your model. I mean, I can put anything I want in the spreadsheet, right? But that doesn't mean that the assumptions behind the analysis is accurate, right? So the question is, well, where did you get that information from? Did you get it from your property manager? Good. Did you go to Rent-A-Meter? Not so good. So to make it as easy for a potential partner to value a deal, you should give them a completed financial model like the syndicated deal analyzer and be prepared to answer basic questions about your assumptions. Tip number three is to have an inside track on the deal. So in order for the deal to be truly valuable to a potential partner, you should have some kind of edge over anyone else. This might mean it's an off-market deal, that's super valuable, and maybe you're dealing directly with a seller, or maybe you're dealing with a wholesaler who has a deal under contract, or maybe it's a pocket listing and the broker hasn't officially listed the deal yet, and they're giving you the first crack on it before they publicly market it. So not only should you have an inside track on the deal, but you should have at least a verbal agreement on a price that makes sense. A signed letter of intent would be even better. So if you stick to these three tips, your potential partner will be itching to talk with you because they're always looking for good deals. Now that we have a deal worth presenting, what's the best way to structure it? How to structure the deal with your partner. Let's talk about how we're going to structure this deal with a potential partner. As you contemplate a partnership with a more experienced partner who will raise the money for you or close a deal, there are at least three types of roles and responsibilities that will determine the equity split or the general partner share. Let's call it the GP share for short. The first share is the contract share. You can give this a weighting. You can say 20% of the GP shares for finding the deal and getting it under contract. This includes performing due diligence, paying the deposit, funding due diligence expenses, and any experience needed to close a deal, proof of funds, anything like that to get it under contract. The second bucket is the raising money share. And maybe you say, hey, look, I'm going to allocate 50% for raising money and securing the bank financing. The last share could be the management share. Let's say you say 30% is for that. So whoever is managing the property after closing. So those are some examples of different ways you can structure a partnership. And then here's an example of how this works in practice. Let's say you and your partner purchase a building for $2 million and requires $400,000 to close. The investors, let's say, get 80% of the deal, so it's an 80-20 split. The investors we call limited partners, or the LP share. And the general partners, you, the GPs, get 20%. So this is how you decide to split the GP share. You got the contract share, right? So you find a deal and your partner helps you analyze it and get it under contract. So let's say you split the contract share 50-50, so that each of you gets 10% of the GP share. All right, so that's 50-50, it's being weighted, and so your share is going to be 10% of GP share for a total of 20%, which makes up the contract share. So 20% contract share, and you're getting a 50-50 of that. All right, that's 10% of the deal. The raising money share is you raise half the money and your partner raises the other half. Again, you split the raising money share 50-50, so each of you gets 25% of the GP share. The management share is you're the primary manager but want ongoing support from your partner, so you decide to split the management share 60-40. So that means that 18% of the GP is going to you and 12% is going to your partner for his or her ongoing role in the deal. So if you add all this together in a spreadsheet, okay, you would get 55% of the GP share. You found the deal, you're raising some capital for it, you're managing it, right? And your partner will get 45%. The terms of your arrangement would be defined in the operating agreement. Now this is only an example, and how you end up structuring the partnership will vary, but hopefully it's going to give you a methodology that will allow you to negotiate a general partnership split with your partner that is acceptable to both of you. How Patrick Duffy did his first 69-unit deal without experience or his own money. How is it possible that a 27-year-old with no experience or capital can close his first deal, a 69-unit apartment building? I'm gonna let Patrick tell this story next. I was programmed like so many other people to go to college, get good grades, and get a good job. I got good grades and graduated from Harvard with a degree in finance. My family had inherited a small apartment building, and I saw from a distance that they generated mailbox money every month. After graduation, I worked for a residential lender and made loans to real estate investors like house flippers and landlords. A few years and several jobs later, I decided I didn't want to continue working like this for the rest of my life. I saw these real estate investors making money with their house flips, but I always thought it would take too long and it was way too much work. I then learned about apartment buildings and began looking into it. I talked to other people I met and slowly began to educate myself about apartments. I liked how passive the income was and how quickly I could replace my income. I felt like if I could learn the lingo and find a partner, I could do this. I joined Michael's program that allowed me to partner with him. Through the program, I was able to upload my syndicated deal analyzer and get feedback from one of the coaches. That gave me the confidence to start making offers. The program at the time was called the Deal Desk, and I got Deal Desk privileges, which allowed me to partner with Michael if I found a good deal, and he would raise the money for it. That's why I started to look at projects that were bigger than 50 units, even though I didn't have the money for something that big myself. One of the guys I talked to about getting started with apartment buildings said I should consider Memphis as a location. He said property there doesn't appreciate much, but the cash flow is above average for rental property. So I started looking at Memphis and came across a 69 unit on LoopNet. I analyzed that deal, got feedback on my analysis through the program, and then made an offer. Somehow the broker took me seriously, and I was able to get a letter of intent signed, and then I submitted the deal to the Deal Desk. The first step was a Deal Desk review call. This is a kind of coaching call, and Michael asked me questions to qualify the deal. He told me that not only had I analyzed the deal properly, but I'd researched my assumptions, and he decided to move forward with the deal. We worked out the terms for a joint venture and signed the joint venture agreement. He helped me put the deal under contract, and I used a line of credit for the deposit so that I could get more equity in the deal. Then he started working with me on the due diligence. I spoke with various property managers, I interviewed mortgage brokers, and I reviewed all the due diligence documents we got. Finally, we met in Memphis to tour the property in person, and we decided to move forward to closing. So we do this, by the way, today in our mentoring program as well. So we don't have like a Deal Desk, but we do this through our mentoring program. So if you're interested in our mentoring program, you can book a call and go to themichaelblank.com/call and book a program, book a call with us and see what resources we have that might help you do the same thing that Patrick did. All right, let's go on here. So Michael ordered the appraisal, introduced me to the SEC attorney who began to work on the operating agreement and private placement memorandum. Once Michael had commitments from the investors, he asked me to get them to sign everything via DocuSign. It was just a matter of getting him to wire the funds to the closing attorney at that point, and then we met in Memphis again to close the deal. At closing, I got my deposit back and any expenses I had before closing, plus a very nice $19,000 acquisition fee. It was awesome. It's hard to describe how important that first deal was to me. I now feel like I could do a huge deal. In fact, by the time we closed this 69-unit deal, I had 196 units under contract. There is no question in my mind that I'll be involved with 1,000 units in the next 12 months. And in fact, he was involved in 1,000. He owns over 2,000 apartment units right now. So many financially free real estate entrepreneurs started by partnering with someone. In fact, it's most common. And that's how Patrick overcame his lack of experience and money to get into the game. The bottom line is this: don't let your lack of experience or capital stop you from pursuing your dreams of financial independence with apartment building investing. Instead, partner with a more experienced investor like Patrick did and get yourself into that elusive first deal. And once you do, the sky's literally the limit. Strategy number 3, invest passively. All right, the third strategy to get your deal done faster is to invest passively. If you have some capital yourself, then a great way to get started with apartment buildings and do your first deal faster is to invest passively in someone else's deal. As an investor, you obviously enjoy the returns and the tax benefits like any other investor, but you're investing with a bigger picture in mind because you eventually want to be a syndicator yourself. Now, I want to emphasize that to be a good passive investor also requires you to know the ins and outs of apartment building investing. And so again, as a passive investor, you still need to know about evaluating markets and deals, the investment process, how plausible the syndicator's business plan is, exit strategy, etc. In other words, you still need to educate yourself. To treat a passive investment as a stepping stone to doing your own deal, find a syndicator or operator to invest with who will help you participate more actively in the deal. Not officially perhaps, but maybe informally. He or she might give you access to the due diligence documents, answer questions, allow you to join them on the property visit, maybe even come to closing. So investing passively in someone else's deal is a great way to do your first deal and start your journey of building passive income for yourself. Best of all, it's something you can do in 90 days or less. Find an experienced operator who's currently raising money for a deal and invest with them. If you like this strategy, you might really like the next strategy. And that's strategy number 4, to become a money raiser. Strategy number 4 is to focus on becoming a capital raiser. Now, this strategy involves you partnering with other syndicators to help them raise money in return for equity as a general partner. Raising money for other people's deals is a meaningful way to build equity and cash flow in deals without having to find a deal yourself. Now, this strategy would be a good fit for you if you want to be a syndicator and you have financial commitments from investors, but maybe you haven't found a good deal yet. Or maybe you don't want to be a syndicator at all. You'd rather spend time raising money and connecting investors with deals that you evaluate. Or maybe you're a high net worth individual with access to other people with money. So those are all 3 good reasons for you to consider this strategy. And this is the strategy, for example, that Lane Kawaoka decided to pursue to build passive income and eventually quit his job. Lane is a city project engineer and a licensed professional with a master's degree in civil engineering and a bachelor's in industrial engineering, both from the University of Washington and Seattle. Working as a highly paid professional in corporate America and frustrated by the traditional wealth building dogma, Lane began looking for a way out with real estate. He bought a couple of rentals but didn't like how much trouble they were, and then tried some turnkey investments, which were more his style. But he couldn't figure out how to scale that to the point where he could quit his job. And that's when he started looking into multifamily investing. He liked the passive nature of his turnkey real estate investments, and he didn't like the idea of syndicating his own deals. Instead, he began conversations with other syndicators who had deals that were raising money for. Lane decided that he wanted to help these syndicators raise money, and he would receive a portion of the equity in the deal. He would become a general partner, establish a track record, and build passive income and long-term wealth. Best of all, he didn't have to find, negotiate, syndicate, and manage the deal. Perfect for Lane. Now, if you have access to capital or you think you might enjoy the activity of raising money, then become a money raiser for other syndicators. Not only can you use the strategy to do your first deal in the next 90 days, it might be a fabulous way to become financially free without being the lead syndicator. Well, which strategy do you think works best for you? Let me know in the comments below. Subscribe to my channel and I'll see you in the next video.